I'd like to congratulate everyone on making it to the last panel of the day ahead of happy hour. So congrats to all, and hopefully we can enjoy another lively panel discussion and no one falls asleep. I know I needed the afternoon coffee. So our fifth panel today is institutional perspectives on the closed-end fund market, structure, trading, discipline, etc. My name is Dan Silver. I am a closed-end fund portfolio manager with Closed-End Fund Advisors. Our esteemed panelists, I'm going to ask you to introduce yourselves, and it would be great if you could give a little bit of a bio, a little bit of information on your firm, the strategy, and especially the turnover profile that you have so people can understand. And I'll tell you what, why don't we go from David to the other side?
Am I on? Yes. Good afternoon. I'll start with a disclaimer, just in case anybody thought I was David A. Tepper of Appaloosa Capital, owner of the Carolina Panthers. I'm not. I'm just A. David Tepper. And I'm a little bit of an outlier on this panel. I wouldn't consider myself an institutional investor. I'm an independent, relatively small-time registered investment advisor in San Francisco. I've been at that for 35 years. I was a broker with Gene Witter for much of the 1980s, and I lived and worked through the rise of international investing and the boom in closed-end funds from that era. At one point, I mean, it was huge. At one point, there were two or three Brazil funds. There were 4 India funds. There were Thailand funds and Latin America Discovery Fund. And many of those funds, there was the inevitable bust, and they fell by the wayside over time. And in the last 40 years that I've been investing in closed-end funds, we've seen similar things with MLPs and some other things. And as Wall Street is wont to do, if there's a trend, they'll ride it as far and as long as they can. I sort of take a top-down, bottom-up approach, looking for macro trends I think I want to that are viable and investable, and then typically when the negativity on those sectors is at maximum, so are the discounts, and I look to buy a discounted asset class, a beaten down asset class at discounts that are unusually attractive, and I've been doing it for a while.
Hi, my name's Rob Shaker. I work at Shaker Financial Services, a company started by my father. We've been doing this for about 20, 30 years, managing separately managed accounts using almost exclusively closed-end funds. But we actively manage them. So the general concept here is what we call discount capture, in which what we're doing is we're taking a traditional model. It's probably best with an example. So if you have sort of a 60-40 portfolio, we're going to take the 60-40 and get 60% equity across a whole bunch of different closed-end funds, the 40% in a whole bunch of different bond funds. What we're going to do is we're going to actively manage that, tactically trading, trying to find, for example, a bond fund that's artificially wide. We're going to buy it. We're going to sell it when it narrows back and replace it with something else that's artificially wide. So in terms of turnover, we'd love to do as much as possible. Because every time that we do, we get what we call a discount capture. That's the idea. If you actively manage, you can take a traditional allotment and then just keep adding little additives through this discount capture. And that's what we do all day.
Mark Milner, I'm with Parametric. I'm sure you've heard of Parametric. We are also owned by a small little rinky-dink upstart you may not have heard of called Morgan Stanley. They're new, so just give them a chance. I lead their systematic income team. One of the things within our systematic income suite is what we call enhanced income. It's basically a fund of funds or an SMA of closed-end funds. And that's used across not only Morgan Stanley Wealth Management, but also other firms as well. Our process is a systematic, rules-based implementation, but using the same dynamics that the two gentlemen to my right have talked about, discount capture, and obviously trying to maximize yield as much as possible. We have about, call it $1.5 billion under management on the closed-end fund side. Oh, and turnover somewhere in the 20 to 40% range. Of course, depends on the market condition.
Great. And I'm John Cole Scott. I may be doing the introduction for the benefit of our audience from home, but I am the president of CEF Advisors. It's a firm that my father bought in distress at almost his 60th birthday, and we overlapped for 19 years of his 15-year career, leveraging his time as a journalist, a book in closed-end funds in 1990, a newsletter called the Scott Letter in 1988 to 1996 in print, which you can find on our website if you want to read old versions of closed-end fund news and history. And we are basically have developed ourselves as another separate account manager like my peers, but we've really focused on, besides closed-end funds, we've been an active investor for over a decade in listed BDCs. We also have had an interval fund database since 2017, used those as appropriate for our separate account clients. And then recently, we have added ETFs as a tactical sleeve or fill the holes in asset allocation as appropriate to certain of our clients as we expand our opportunity. The main way I think we're different than many of our peers is partially I say yes to most ideas. So we have 17 different composites. And because Dan Silver and I manage our client portfolios separately, independently, and there's a lot of uniqueness, whether it's a different type of client. So a lot of nuance. And one reason we can do that is because with CF data, we can report our daily all of the closed-end fundness or holdings data to our clients or prospects. So I think I covered everything, but let me know if I didn't, Dan.
No, you definitely did. That said, John, I'm going to stay with you. I would like to shift to the topic of discounts. This is a closed-end fund panel. Things do not trade at NAV, or at least very rarely do they trade exactly at NAV. Maybe you want to kick it off by commenting on current discount levels, anything that stands out to you?
Yeah, so right now, like the average of sector equity, taxable bond funds and muni funds are trading in mid-single 5 and change discounts. That is mildly wider than like a 10-year average. But there's obviously a lot of unhomogeneity inside those sectors. The one area that generally trades wider than that are the more traditional, classic global and regular U.S. stock funds. Those are usually lower yields when they're there and have generally been not the most excited use of the wrapper. I'd say what we find, and again, with our process of balancing discounts, balancing not only the distribution style or taxation for our clients and kind of the net NAV or manager analysis, is really understanding what's causing that discount. And what we look at, some discounts are driven by headlines in the market. So that might be what's happening in the world around us today, whether it be tariffs or other, inflation. Other discounts are driven sometimes by the mechanics of the fund themselves. So discounts widen out generally during a rights offering, as they're usually doing that below net asset value. Studying that and understanding those discount relationships is important for our work, for our clients. Just like also when a fund decides to do a tender offer close to net asset value, there's a discount tailwind there. So I'd say the discount view that we look at, we're in a moderate level right now. It is constructive for possibly more primary funds, maybe second half of next year, but can I update you July 1st? And we're notice that the discount volatility, when we look at our portfolios routinely, whether it's this year, last year, 10 years ago, we find the average discount for a basket of our 35 to 40 positions for clients moves around 15 to 20% around net asset value on average for that basket, which is why we always argue for even regular financial advisors to be a little bit tactical, because there's times where you can buy extra cheap and sell extra narrow.
Before I pose a follow-up about the kind of the outlook for discounts in the near term or even the next 12 months, Rob, I was hoping, do you think you can explain, your view on discounts, but kind of teeing off of what John said about discount volatility and how you would kind of characterize the current environment?
Yeah, so I'd agree with John, and at one level that I think currently you have a broader range of corporate actions affecting things. As a closed-end fund investor, one of the things you have to do is you have to monitor discounts, right? Because if things are moving. That's just something you need to know. There are times in which everything moves. There's fear-based, right? Right after Liberation Day, everyone got scared. Everything goes really wide. That's going to come back. That's what we call generic, right? Everything's sort of moving down. If you're watching an individual fund and all of a sudden you see it widening, the first thing you have to ask is why, right? That's what we love, right? We love to buy them when they're widening, but we have to check to make sure that it's not because of something, right? If it's just because of excessive selling pressure, maybe some big institution is trying to get out of it or someone's trading it lazily, that's great. We can buy it. But what if it's a rights offering, right? Rights offerings tend to it just sags. And you basically kind of have to wait that out, right? What if it's a merger, right? A lot of times you'll see there's an example going on right now where there's 3 funds merging, right? And technically you might think, oh, they're just going to all sort of meet in the middle. Well, I find personally that they all just sort of sag to the lowest guy, and they'll just all keep sagging because it's, you never really get buy the lowest guy, but if some guy is 2% narrower, you're going to sell him, and there's sort of more selling pressures. So you sort of have to be watching about what's going on. But this time of year particularly is the one time you do know there's going to be widening, and that's for tax loss selling. It's a great, the closed-end fund environment is a great place for tax loss selling because there's so much yield going out there. There's so much income coming out that you're going to be able to realize short-term capital losses in a lot of things, even if they were sort of flat on the year, especially if some of these guys who are going to give these huge year-end distributions, you're going to be able to have tax loss selling. And where we sit, we've started doing it earlier and earlier in the year, especially coming off back-to-back 20%, and another strong year. You got a lot of tax loss selling going on, and knowing that you have to let it sort of sit for 30 days before you can get back in, and knowing that there's going to be all kinds of bargains the last year of, right after Christmas, it's a really good time to sort of front load that. I think a lot of people are. You've seen a lot of different individual ones sort of widen out.
Well, you got 2 topics there I want to come to later, and that's the tax law selling season as well as yield income distributions kind of in general. But I was thinking, Mark, do you think you can chime in, as you mentioned earlier, right? So your approach is systematic, rules-based, but also with a yield focus on kind of how you think about, not sensitivity, but the importance of discount in your framework and whether or not this is, good, bad, or indifferent on?
Yeah, I think discount, of course, is always important in closed-end funds. I don't think anyone up here on the stage makes it a habit of buying things at a premium. That's not how any of us sort of make our living. We do things from an execution standpoint. It's a systematic rules-based strategy. However, there is obviously active management component to that as well. But everything that we do in our strategy, but everything we do at Parametric in general is all research-based. And so John's research, I'm sure, will tell you this. Our research will tell you this. Buying funds at a discount and then obviously selling them when the discount narrows and then sort of repeating that trade over and over again has historically been a winning bet. And when you do that sort of within your various asset class groupings, I'm not going to say we're completely agnostic to the individual funds, but we're certainly a little bit less sensitive from a fund A to fund B if those fundamental characteristics indicate a buy-sell opportunity. So sort of as a whole, it all works out because we're large and diversified, not only across the actual asset classes themselves, but the holdings within those. So we're able to do that. If you're running a much smaller, more concentrated portfolio, may not be the best thing. If you're obviously heavier weighted into an individual fund that may have some idiosyncratic risk in your portfolio. On a diversified basis, it works out well for us. It's been great.
Yeah, David.
On the subject of discount, one thing I would add is, at least for me, the absolute size of the discount is important, obviously, but also the relative current size of it, the current discount relative to the historic discount of a given closed-end fund. At CEF Connect, you get the average discount over the past 1, 3, 5 years. Let's say it's been around 4% and the current discount is 8%. to me, that's pretty attractive. Whereas if the average discount has been 10% and the current discount is 11%, on a relative basis, I don't think that's as attractive a situation. So I might be inclined to buy the 4%, now 8% discount versus the 10%, now 11% discount. And conversely, I wouldn't, it's a rule of thumb that I don't stick to all the time, but if the discount at some point, let's say, I'm not as active a trader as Mr. Shaker here. But, if the discount at some point is, let's say, 50% of what the average discount has been over the last 1, 3, and 5 years, well, to me, that's when the fund might move to my sell list and give some consideration on that basis. And again, at least for myself, I think how the NAV is doing and how that asset class is performing. Probably my biggest mistake has been selling too soon, because as we've seen time and time again, when at market peaks, that things can go up a lot further than anyone is expecting, and conversely, typically I buy too soon on the way down, I sell too soon on the way up, and you can wind up leaving a lot of money on the table.
Well, along those lines, if I could just have you follow up on that. So one of the things that came up in prep for this panel is you had highlighted the importance of total return and capital gains, and not just the income focus that many closed-end fund investors have. David, do you think you could talk about kind of not only the capital gains piece and obviously how it fits with your turnover profile, but the idea of it, there's money to be made by staying long. It's not just discounts.
Absolutely. I think when the internet bubble burst in 2000, 2001, and the yield curve got very, very steep, we saw creation of a boatload of closed-end funds designed to use leverage to exploit that and to generate outsized yields, whether you were leveraging a portfolio of utility stocks or MLPs or REITs or bonds. And I think to the long-term debt, that distracted people from the capital appreciation that a well-run closed-end fund can provide over time. I mean, if you look what the Adams Equity Fund has done, General American, Central Securities, some of these funds go back to 1929, and I do think they exploit some of the features, aside from the use of leverage, that the closed-end fund structure offers, where you can invest in smaller companies, less liquid companies, in some cases private companies, and again, and also the manager is not forced to buy more shares as in a mutual fund when the money's pouring in, and the manager is also not forced to liquidate stocks that he likes to meet redemptions. And that's, if you talk to some mutual fund managers and get them to talk honestly, I think they'll say that's one of the problems of managing a mutual fund, is managing the cash flows in and out of the fund. And the closed-end fund structure insulates the portfolio manager from that burden.
Okay, well, kind of shifting gears, I'd like to talk about distributions and yields. And there are kind of like three things that I'd like to talk about. I guess we don't have to do them all at the same time. We can kind of unpack it layer by layer. But to talk about current yields, the sustainability of those distributions, certainly, in relation to what's going on with the Fed and what the Fed is up to. I'm curious whether you guys are happy or sad to see potential distribution or dividend cuts. And the last part that I'd like to get into is return of capital. So I'll tell you what, John, you want to go first?
Sure. So right now, the average closed-end fund, as we measure with our Equate 15 index at CEF data, yields about 10%. What we've seen in the last couple of years is Thankfully, a steepening of the yield curve, not quite as steep as earlier periods, but a very benign yield curve for closed-end fund leverage. We have seen many funds, I think it was yesterday, BlackRock was saying for their munis, and when we're over 40% leverage in our muni funds, that means we have a far more positive view on the yield curve. When we're below 30 on average, that means we're more concerned about the yield curve. One thing that's changed as a result of kind of pressure on the sector after some tough years is fund sponsors that previously would have been very distraught to have return of capital show up in their 1099 dibs for their clients are now using them as a way of managing their discount. One way we've changed our thinking about that at CF Advisors, we do enjoy, as I'm sure my peers do, oversubscribing to tenders because we typically get 2.5% times the stock because most retail and most FA don't do tenders. We now talk about these overdistributions as democratized tenders because they do hit every shareholder. And anytime you buy a closed-end fund at a modest discount and it overpays distribution, it's basically better for the shareholders and worse for the fund sponsor because they're losing capital they bill fees on. When we think about the characterization of dividends, we use as a big part of our work for our separate account clients. We recognize that not every fund is going to maintain the same flavor of their previous one-year dividend classification, but we find that for asset allocation mixes, it's very stable. The amount of short-term gains, long-term gains, QDI, return of capital. There is return of capital that's actually accounting, and we use a rough 3-year NAV return versus 3 NAV yield. It's not a perfect data point, but we designed it 11 years ago, and we've learned in our data business to not change rules as actively as we change our portfolio holdings for things. So I think that kind of covers our thinking about it. It's part of the structure and a way of helping to keep discounts narrower, which allows investors to have funds to use and hopefully gets the market back to a footing where the fund sponsors can figure out a way to bring new interesting funds to market for the benefit of the 4 of us.
Along those lines, Mark, you had said in preface call that 2025 is a weird year because of both distribution levels as also discounts. Do you think you can kind of expand on that as it relates?
Yeah, I think John kind of touched on it at the very beginning on sort of the current discount levels. We've kind of had, I would say, general narrowing maybe to start the year. Obviously, Liberation Day kind of liberated us from narrower discounts, at least for short term. Continued narrowing maybe throughout the summer and early fall, and now we've seen a little bit more widening out. If you look at it on a broad basis, however, if you cut it down to the asset class level or sector level, you see some very different results. You see, 200 to 300 basis point or more discount narrowing in things like infrastructure or real asset type funds. Meanwhile, you see the exact opposite in, convertibles or leverage loans. So there's definitely been kind of a roller coaster there. So, if you're just pure discount capture, you can end up focusing too much on a single sector. Meanwhile, you're gonna get it somewhere. On the distribution side, John mentioned BlackRock. They've got a couple of feline tickered funds, cat funds. We could probably figure out which ones they are that have a 20+% distribution rate. And I don't think there's a single person in this room that thinks that that's a sustainable long-term number. They were very coy about that and maintaining that yesterday. But I think the moment that was announced last year, of course, as a result of all the activism in early 2024, my first thought is great. This is awesome for the portfolio. Now, when are they going to cut it? So, I think since that time, it's been about managing position sizing for what I would say are those elevated and in this case, outsized distribution, because obviously with that subsequent distribution cut will come a price fall and the discount will widen out significantly.
Oh, Rob, I'm curious, how does that work for you guys in your strategy in relation to potential cuts, right? Does that disrupt kind of your approach, your model? Does it kind of break the discount focus?
No. So, as a starting point, we don't care at all about dividends or yield. We care about total return. And so if someone said, some fund says, I always find it funny with equity funds. I'm an equity fund. I'm going to say it's with the S&P 500, and I'm going to say I'm going to give you 10% back as yield. That doesn't make any sense. Markets go down some years, right? There's no way that you're actually thinking that that's the estimated earnings. You just know they're going to give you back 10% in cash throughout the year. Great. It comes right off the price. You just got to build that into your total return, right? Your total return is whatever the change in the price is, plus or minus whatever dividends they put in your account, right? And so we're agnostic about the level of dividends because we're only caring about total return. But there is this thing in which sometimes people really do care about it. So if there's a dividend cut and you might have a mandate that I have to have everything in my client's account that's at least 8% yield or 8% income, that if it then moves to a 6, you got to sell it, right? If you have to sell it, then you have excessive selling pressure, right? And it sort of goes back to what David was saying. The difference in one of the most important things to remember about closed-end funds, the difference between mutual funds and ETFs and closed-end funds, the real big difference is that fixed capital structure, which means when there's excessive selling pressures, there's not redemptions, there's widening. That's what happens, okay? Because they can hold on, the managers can keep doing what they're doing. It's just going to widen. So when everyone got scared at the Liberation Day, right, none of the managers had to do anything, and the NAVs weren't affected by it. I mean, except how they were affected. They weren't affected by the excessive selling pressure, but the discounts were, right? Everything widened. Then things stabilize, everything comes back up, right? So if you see a dividend cut, our typical rule is 3 days. It takes about 3 days for everyone who has to get out of there to panic sell it, right? And you'll see it. The day that the dividend comes out, somebody sells a whole bunch down 1% or 2%. Later in the day, another guy comes in and sells $500,000, pushing it down another percent. That lasts about 2 to 3 days. All those people sort of get done, and then you can start building your position back up, and it'll probably narrow back.
Mark, I'm curious kind of, again, to harp on as it relates to your strategy and how you think about it, the idea that there are fake yields right now and how you think about what you like, what you don't like, and kind of how do you prepare for the inevitable?
Yeah, I guess a couple different ways. I mean, diversification gives us that buffer, so we're not sort of married to a single sector, a single asset class. Using that rules-based process that blends not only the discount, which, you can also think of as a sort of a sentiment gauge, but also, Mr. Tepper mentioned, relative discount is another nice thing to look at. And then volatility too, not just the price volatility, but the NAV volatility. So you understand what the underlying drivers are of those funds themselves. And so when you marry all those things together with a diversified portfolio, you can ride those out. And we know that just like discounts, distributions will ebb and flow. Hopefully not as much, but we're sort of in this higher than normal, higher than average distribution environment, which I think any prudent manager would be informing their clients will not last forever. The Fed is currently in a rate cut cycle. Presumably we're going to get another one in December and possibly 2 more next year if you're going to use sort of the consensus guide. Obviously that's going to put pressure on distributions overall. I think from a leverage standpoint, it's sort of been talked about. Hopefully that should help. The cost of leverage comes down. Then that also increases the use of leverage as leverage, the cost of it decreases. So, there is some trade-off there, but I think, the long term or the interim term, the next maybe 18 to 24 months, we'll probably see a slightly lower discount environment.
John, I'd like to follow up because it's something you've mentioned in the past. If you were giving advice to boards who are assessing distribution levels, what would you say they should or shouldn't be doing now, and what should they or shouldn't they do if they decide they need to make a change?
So the easy question. I would say there are still some closed-end funds that are maintaining they earn the dividend policy, and that's important to them. It's far fewer than 2 years ago. I would say that it's really important as you think of your distribution policy that it's a number that you believe long-term that you can meet through total return, or you're basically slowly killing the fund. As funds start to get smaller, you start to have higher fixed cost, which starts to increase the erosion of net asset value. Gets harder for investors like Parametric to own you. And so that's an important thing to consider. And it's a tough balance because some people will say, they're just doing this for them. Again, they are trying to give a better price to NAV for their shareholders, and that's a positive thing. We want more positive experiences from retail investors, from FAs and RIAs, which are a large bucket of the ownership base of the U.S. closed-end fund markets. And I would just say, I like where one of my favorites is just a really good, thorough, like the 2% a quarter. They're not right there right now. Is a good long-term number for most asset classes. They're elevated right now, but that means that over time, that type of policy adjusts with the market. We generally would say that's a more positive distribution policy than X cents per share, because that doesn't opine about whether markets are up 20% or down 20%. It's a lot easier for folks to model for that will be looking for that experience. Even 10 years ago, we've been tracking dividend changes since we launched CEF data 12/31/11. I mean, it's about 10% of dividends are changed almost every quarter for the last 57 quarters of our review. It's just the magnitudes got larger, and it's even, right now we're seeing increased cuts or future cuts for floating rate loans because logically they're getting less yield because the market's getting cheaper. And you go back, I think, roughly 3 years, they're still yielding almost 300 basis points more than where that sector was 3 years ago. And so we just remind our investors, we remind boards that when you're a floating rate product, you're going to float. There's a positive to that when rates go up. There's a negative that rates go down. Just keep it simple and don't be too cute about it. And just talk about it in strong, direct terms in your communication with investors, whether it be institutional investors or FARA.
And if we can just shift slightly to the topic that came up earlier, which is tax loss season, I'm curious, and obviously, Rob, you had hinted a little bit or mentioned it earlier, what your expectations are this year for tax loss selling, whether or not you think it'll be a factor or not, and how you kind of think that may or may not fit with the liquidity situation we have in the markets in general at the moment, or close-end fund. And I'll tell you, anyone is welcome. John, if you go for it, it's all you if you want it.
Quick, I forgot to say, we tax loss sell a lot. I think for some of our taxable clients, we think we've done 7 times this year. We will trade cost a lot level losses for some of our clients. In my review, there's senior loan funds I think are ripe for tax loss pressure as a sector. I think there's even going to be some mild across munis because there's basically roughly cost basis down on year for share price. But for convertibles and some of the equity funds, I don't think that their prices have really dipped below their early in the year prices. So there should be less pressure there in how we think about the tax loss season. But we find that there's generally 3% on average in most years, not every year, because that's the way markets work. They don't always hit your goals. And we do find that the tax loss season really buckets into either close to mid-November or close to the last week of December. Really strong trends. It's very rarely between those 2 points. It's usually anchored to the front of the season or the end of the season based on the trend of that year.
Rob, is that consistent with what you were hinting at timing wise, or?
Yeah, I think that the 2 bottom points are typically from where we see sort of like right before Thanksgiving and right before Christmas, you could kind of say. Those are, más o menos where it's going to probably hit a bottom. But this year, I think there's a little bit something interesting because of those big year-end distributions. And so you'll have, for example, GAM. Not a lot of people were able to tax loss sell that guy until they did the year-end distribution. And then all of a sudden, now there's a little bit, for some people, there's an opportunity. And so you got some selling pressure right after it. I actually think from what I'm seeing that people might be gaming that too. which is something you can sort of be on the other side of. I think you'll see if a big year-end distribution comes out, you're seeing a little bit of buying pressure into it. Because you can do that, you buy it, let it take the big distribution and then realize a giant short-term capital gains loss. So at least on the ones that have so far come through, and it's typically on the equity side, then you're seeing that. We'll see if that plays forward, but I think if it does, then we may have more of that, as John says, every tax year is a little bit different, but I think we might have more of a sort of end of year bottom, but orderly. No, nothing. It's not orderly.
Okay. And David, I'm curious. So I definitely would like to kind of poll the panel about the prospect or potential for IPOs, and I don't know, let's call it the medium term. But before we go there, do you think you can, I mean, you've got more experience. You've been doing this for longer than we have. How have things changed? And I asked that in relation to if there was going to be an IPO, what do you think is either appealing or unappealing in terms of a focus or strategy, et cetera?
Well, I've been on both sides. I was a broker in the 80s when there was a huge, as I mentioned earlier, a huge number. There was a boom of closed-end fund IPOs, during the international investing wave. And to be honest, I've avoided them ever since. And, and I know the investment world has, tried to structure them so, the NAV or the discount doesn't go to 5% the next day or the first day the shares trade. To be honest, I really haven't thought about it very much. And certainly I'm not expecting another boom of closed-end fund IPOs. And typically, I note what's happening. Typically, it's a way of exploiting a current trend. And, as just the private or the previous panel, this whole private equity, private debt movement, I'm a little suspicious of. I remember it was in the late 90s, I think it was MVC Capital, or there was a closed-end fund that was going to be a venture capital fund. And it was a way to bring in the average retail investor to give them exposure to this area that was previously an institutional domain. And it pretty much called the top of of that market, of that wave. And, so I'm very suspicious, and I'm not holding my breath. I mean, on any closed-end fund IPOs.
I guess on the other end of that, Mark, you said in prep that you think there are opportunities for new closed-end funds. And I'm curious what you would want to see or not want to see come to market.
Yeah, I guess I haven't thought as much about what I don't want to see. That's a good question. Well, I'll think about that while I'm sort of answering. And, selfishly, I think I always want more investable options out there. I don't think anyone at this table would disagree with me there. The previous panel talked about, using privates. I think the current regulatory environment is much more conducive to putting other things in the closed-end fund wrapper, which I think is great. That fixed capital base is advantageous versus call it our ETF cousins. The other thing too, when you look at it compared to all the explosion in new filings for ETFs, is that closed-end funds with a fixed capital base, we don't have to worry about the basket sizing like you did for creation and redemptions with ETFs. And so you can stick longer term, less liquid things in there. And it doesn't have to be something as crazy or sexy as anything on the private side. Just for example, it could be something as vanilla as an active equity fund with a buy right component, but you write covered calls on the individual names because you can get called away. You can write more calls or you can write longer dated calls versus sort of the traditional space where we have your active equity or index type equity exposure with an index option. So that's great. But guess what? You can actually generate more yield. I know I'm back on my yield topic again. You can generate more yield writing on individual names than just writing on the index. So there's a more vanilla way to do it. Another thing too is that, okay, so you want obviously not to trade at a discount immediately. And some of that's beholden on all of us in this room and investors to not sell right away if you get an allocation. So then how do you do that? Okay, well, why don't you look at the current funds right now that are trading at a premium? Clearly there's interest in certain types of funds. So maybe, I don't want to say create clones of those, but that should give you sort of a hunting ground of opportunity for new things. And yeah, as far as stuff I don't want, I don't know. I'm still also have to think about that one.
Fair enough. Fair enough. Okay, well, there are a few other questions that I've got, and I want to at least give the audience a chance. But before I open it up, it would be great if, so I really liked the last panel. Chuck did a great job saying, this time next year, what is going to be the story of 2026? I think that is a much better way of saying, what's your outlook? So I'll tell you what, why don't we go from this side down? So David, starting with you, what do you think? Or, hey, it doesn't have to be the only one. What do you think will be a story of 2026?
I'm going to pass.
Okay, fair enough. Nothing wrong with that.
I'll go with the average bond fund will trade at a premium.
Okay.
So Parametric is notorious for not making market calls or predictions. So these are just be entirely my own and closed-end fund specific. So don't report this back to anyone. But I think we're going to see continued interest in sort of the real assets, real estate, infrastructure type space. So probably continued discount narrowing there. Again, probably to premiums for some of those. And then just by and large, I think the aggregate distribution level will come down slightly.
So I will agree completely with those previous two comments, but I'll add, I think that with a very benign yield curve and with such good use of the wrapper for both preferreds and munis, that those sectors will trade a lot tighter to book, and some more of their funds will trade above net asset value because of where the yield curve sits and where we are in the stage of our feelings for equity markets, and we use those funds actively. And I do think that the yields will come down a little bit so that they're more closely aligned to potential long-term total returns for those two structures.
Okay. David?
This could be wishful. It is wishful thinking on my part. I think small cap stocks might have they burst, and they've been, the gap in performance between the S&P 500 and the Russell 2000 over the last 1, 3, 5, and 10 years has been at historic levels, and I think there may be some reversion to the mean on that.
Yeah, from your lips. Okay, well, let's see. I'd like to see if we can get any audience questions. Is there? Oh, we've got a couple. All right, you're closest. So Phil, you're first, and then Ron will shift to you. Over here, sir.
Thanks. Those are very interesting predictions. First I want to just make a comment about the prospect of the IPO market. I mean, you take this for what it's worth, but I heard from a pretty reliable source that Bill Ackman is going to be coming back after his failed, $50 billion. I mean, that's sort of a bit of delusions of grandeur there, but that he's going to be coming back with a closed-end fund, not 50 billion, but sizable. And it could be a unique structure that could, I don't know, it could jumpstart the market, you know. I thought your idea, Marco, was about, well, why not see what funds are trading at a premium and come out with a clone and say, look, this is a better deal. That's a good idea. But if Ackman does this, you know, and he's got some success, you know, things in. We're all, you know, a lot of people are ready to bury the closed-end fund market, but they've been doing that for 150 years. But I want to ask an open-ended question as an activist investor in both closed-end funds and outside closed-end funds. I mean, I started investing personally in closed-end funds in the mid-'70s, and there were not that many that were listed. They were only listed in like Barron's or the Journal on Monday. And, you know, you would see plain vanilla S&P clones like Tricontinental or Lehman fund trading at a 25% discount. So my open-ended question to the panel is, what's your view of activism in the closed-end fund space? Good, bad? Does it help or hurt? And if there were, and related to that is, what do you think about some of the pretty onerous anti-takeover provisions that some closed-end funds have taken to deter activism?
I'll start that because I use your name when I'm talking to clients. And I say, you know, because one of the things, you get these generic widenings and they're scary a lot of times, right? And the concept that, oh, what if all the closed-end funds go to 20 discounts? And I say, well, then Phil gets involved. And so whether or not I particularly care for what activists are getting at the end these days compared to back in the day when we tried to open-end them and things like that, I think the activists are getting a little bit less beneficial to but they still serve that really, really fundamental purpose of letting us all know that there's a floor, because they can't stay down too long because the activists will get involved and then you're going to win big. So I think that's a really, really incredibly important aspect of closed-end funds, that there are activists there that are sort of the watchdogs.
I agree. I think they've had a positive effect. You know, one of the reasons I think, you know, discounts have gotten narrower is is because of the activists. I think there's more capital committed to that space than there were in the 1970s. And you know, and as a share, my clients and I have benefited from this. And, you know, if I wake up one morning and I see a fund's up 12% on an activist action, I'm certainly not complaining. And the notion that there would be too few closed-end funds if all the activists took over 50%, that would be a bad thing. Well, you know, my clients and I, we move on to something else with some very handsome profit. So I don't have any problem be more active.
Okay.
You know, I'll do a quick
I'm
answer.
sorry, Chuck.
I'll just say, as I think about that, I mean, we think that right now, because of a lot of the pain that the fund sponsors felt in the last couple of years, they've been forced to create a lot more beneficial outcomes for all shareholders. I hope that they keep that memory alive longer than they sometimes have. And I keep thinking that they work to, I'd say, be in good communication with investors in ways that we understand that we don't invest in the London closed-end fund market, but there's a lot more direct communication between boards and management and ownership, just from talking to our data clients that both invest in US and UK funds. And I'd say, I mean, I was not trading closed-end funds when Phil was, but my father was writing his newsletter, and I was reading about the discount levels in 88 and 89 and 90 in the last couple of weeks. And the discounts were a lot wider. 2025 was a regular number back then, as Phil was shaking his head yes. And so with more, I would say what we hope for is more pro-structured, diligent 13 filers that can help these products stay lively, useful. And we think that the funds that have taken, I mean, just think, yes, it's because of the terrible IPO experience of Big Z, but repurposing Big Z as BTX to me is a very powerful, positive thing. It gave a 50% liquidity event for those that wanted out, retail or activists, and it repurposed that fund into something that I think is rather useful for the market of U.S. closed-end fund investors in an environment where it's not easy to IPO a fund. And so I could see a place where we are able to repurpose funds into useful. If you think about the Aberdeen Country funds that became AEF, that's a far more beneficial fund in today's market than having an Israel fund and a Chile fund. I know my father loved the country funds because at the time he invested in these funds, but that's how I think of it. You know, it will always should be around. And I think that we need to find a ways for institutional investors that approach structure, have good conversations with management to make sure it's a good outcome for all investors, not just the activists, and not just, you know, and then also make sure retail is included in the outcomes that are positive.
Okay. And Ron, I think you get last Lex.
How do you deal with like turnover and short-term trading versus long-term? And are your clients mostly taxable or tax exempt? So, if you could make a few hundred basis points over an ETF, or like a closed-end fund index, like John's his indices of all CEFs, how do you deal with that? And what would you say the percent of your, like the characterization of your returns are over time between short-term, long-term, and income, and the tax rates of those?
Well, for me, it depends. Number one, if, certainly in a tax sheltered account, which is a sizable portion of my business, a lot depends on the asset. I mean, if you're buying a bond fund that, let's say, you'd be delighted to make 10 or 12% over 12 months, and you have a chance to make 3% in a week, and particularly now, at Schwab, you can trade commission free. I'll take the 3% and buy it and sell it 5-7 days later, and maybe look for an opportunity to buy it back, a week, a month, 6 months from now. But generally, I mean, I've got, core assets, some of the equity funds that I mentioned earlier, that we've held for 35 years and really never sold a share. So it really depends on whether it's a taxable or tax-free account, tax sheltered account, and it depends on the underlying asset and what you're expecting to make, the return you're expecting to make that asset to produce for you.
So, as a starting point, one of the fundamental thoughts we have is we're going to always work to make that extra dollar regardless of how much it gets taxed, because it's still an extra dollar of gain. But that being said, it's something to think about, especially because closed-end funds pay such high yields. What do you average? Maybe like 10%. So now, obviously, my accounts are, we'd like to have like 3 to 4% turnover per year in the accounts. So I can't tell you exactly what the yields are going to be, but let's say they're yielding 10%, right? That means 10% is get reported to the IRS. You can't do anything about that. That's 10%. So the only gains you're possibly, no matter how active you are, the only gains you're possibly putting on the hook for your client is anything above 10%. So as a starting point, that's pretty good, right? Years that it goes down, you don't have to report. You're not going to have, you do your tax loss selling. You're not going to have any gains to report. So it's only above 10. And if you think about it, you're above 10, but you do a good job of tax loss selling and keeping the gains up there, you're probably not going to have to report anything, even with, a 15 to 20% year. My clients basically for the first 23 and 24, we were able to have, with tax loss carry forward, no reportable gains, even though we're that active. Then when you go 20, you start getting to the point where, okay, maybe you're going to have some gains. And by the way, we're half taxable, half non-taxable about. But that concept, just to know that there's so much yield in closed-end funds that's getting reported that I don't think, even in a taxable account, that you really have to be too worried about doing some nice active, taking your 3% in that example, especially if you have other things that are running longer term. You're going to be able to effectively tax loss that away, I would think.
Yeah, maybe I'll just hit up real quick. So we offer both sort of standard versions and tax advantage versions of our strategies. So that sort of dictates the underlying security selection and sort of how we think about the distribution characterization. That being said, regardless of which version of the strategy you're in, I think there's one thing that I try to avoid, and that's the funds that distribute short-term capital gains, especially the ones that recharacterize or announce it, in the subsequent calendar year for the previous tax year. I think that's just poor management from the portfolio manager, from the fund themselves, which I think just reflects poorly just in general on the fund. So try to avoid that. And then to Rob's point, and John, on the sort of 10% distribution, for us, if you're getting 10% distribution and 12%, Rob's a total return guy, 12% total return, you can do the math on what percentage that is. For us, as an income-focused strategy, typically in a calendar year, we're looking at north of 85% of total return from the distribution, and that's on the low side. I mean, realistically, it should be 90+%.
I would say we're roughly half tax, qualified, half taxable accounts. We handle that as part of our onboarding process. We actually put our clients' marginal tax rates and CEF data for their portfolio so we can look at their current estimated tax friction. We find it's very inaccurate for any one holding year to year to year, but it's rather active on a 35 to 40 basket of closed-end funds. Again, we generally will buy for closed-end funds, 2 to 4.5% per exposure. It allows us to, if we're early or surprised, we can always add a little bit more and it not be an outsized allocation for us. And so I'd say it's very client specific. Some of our clients will tell us they are so tax driven, they care more about not paying taxes than their total return after fees, which I would argue is not the brightest thing to do. But when they hire us, it's a reasonable approach. We're able to put in our software and handle that for them. And so I'd say we generally can keep our short-term capital gains down for those clients to 3 to 4% of the distributions available. And then there's years like we took a large 5-year gain on PDX in January in that pop. And we spent much of this year for clients who've had over 5 years of neutralizing that long-term capital gains. We have another position that's up about 100% in the last year or so. And for some clients, we're hoping it stays that high until January. And for some, we've already taken that gain because we've worked that out for them. So we're a very customized approach, differently than I would say Parametric and Shaker in their approach, where it's more unified and a lot more nuance in what we do at CEF Advisors.
Okay, well, with that, I think that concludes our panel. So I would like to thank the panelists.
Thank you for staying through the end. Thank you for showing up all day. The questions on the panels were really well received. If you did get all your questions asked, be happy if you don't have contact information for the speakers to get you in touch with them, get your questions answered. We will be doing transcripts and replay video once it's gone through compliance. A last reminder, Jane will be recording interviews in I'll call it the front porch downstairs until 5. And so if we talked about an interview and you've not done one, or if you think you'd like to do one, chat with me about it and I'll probably say yes. Thank you for being here, and let's enjoy some good food and some good conversation and hopefully a couple of nice beverages. Thank you.